With domestic demand slowing and capex, jobs and consumption under pressure, plus global uncertainty from tariff wars, how is Marcellus CCP portfolio positioned in this challenging macro backdrop?
There are three parts to the answer to this question from CCP perspective. It's a concentrated portfolio, and hence when you look at our larger allocations, you'll see that they include companies whose fundamentals are relatively uncorrelated with the macro factors that you just mentioned. Just to give you a couple of examples, so we have a hospital chain as one of the larger allocations in the portfolio, which is expanding its capacity of hospitals outside of India and operating efficiency gains and margin expansions in its Indian hospitals. Another large allocation we have is a pharma company, which is a global monopoly in API production for ingredients for cough syrups, painkillers, etc., and is a sole manufacturer of patented drugs for the big pharma. To that extent, there is lack of correlation in the variables that drive fundamentals of some of our larger allocations vis-a-vis the macro headwinds that you talked about. Secondly, if you go by history, there have been several periods of weak Nifty earnings due to macro headwinds. During those periods, companies with high quality of moats, prudent capital allocation approach, they outshine versus the broader market. And this is largely because in a booming economy, when Nifty's earnings is let's say strong, you have not a great value of moats and capital allocation to help gun out a strong EPS growth, because the tailwinds are helping most companies gun out healthy EPS growth. This was largely the case over the last 3 years. So from FY22 to FY25, Nifty 50's EPS growth was a 24% CAGR over 3 long periods. That's phenomenally high compared to long-term average of 10, 12, 13%. The saying is, when the going gets tough, the tough get going. The superior competitive advantages and capital allocation of certain high-quality businesses helps gain market share and find new avenues for growth, whilst the broader Nifty earnings is undergoing a very modest growth or negative growth period, right? This is what we expect the broader quality universe to do over the next couple of years, which ends up being a sweet spot for our CCP portfolio. Finally, when it comes to valuations, CCP's portfolio's forward PE multiple currently is about 25 to 30% discount to its last 6-year average. In a way, since inception average for CCP at Marcellus, there's a 25 to 30% discount. And this is thanks to the changes we made to the portfolio construct over the last 12 to 18 months. And also because the earnings growth of many of our portfolio companies has shot ahead of the share price growth of their stocks. As a result, we are actually sitting with a all-time low P multiple on Marcellus CCP since its inception. When you combine the three things together, that's how we see the CCP portfolio to deliver healthy outcomes in a weak macroeconomic environment.
How do you justify a 35 to 40x PE for your portfolio when the market trades closer to 20x?
So Nifty 50's ROE is about 13 to 14% currently. When you compare that against our CCP portfolio's ROCE, return on capital employed, we are gunning out about 30% return on capital, which is roughly twice the cash generation of Nifty 50, right? That's what ROE, ROCE denotes. When you also look at earnings growth of our portfolio companies has been roughly twice that of Nifty 50's long-term earnings growth rate. So Nifty 50 long-term has delivered a 10 or 11% earnings CAGR. Our portfolio companies' earnings growth rate has been in the high teens, closer to 20%. And these two factors together justify a higher PE multiple that our portfolio deserves versus the broader market.
The consistent compounders portfolio was tweaked in 2024. What was the core theme behind those changes, and how is the portfolio better positioned today as a result?
So there are two broad objectives that we have tried to achieve through the changes that we made to the portfolio construction over the last 1.5 years. Firstly, the expected earnings growth of the new inclusions, which we call as enterprising compounders, their expected earnings growth is higher than the expected earnings growth of the exits, which we call as linear compounders. And this is mainly because of high reinvestment rates of these enterprising compounders, which are focused on addition of new growth avenues through reinvestment of capital generated out of their core businesses periodically. The second piece that we targeted through the portfolio changes over the last 1 year or so is wherever valuations have shot up and there are meaningful risks emerging on the horizon, we have proactively reduced our exposure to such stocks. On the other hand, some of the enterprising compounders we've added to the portfolio are actually yet to be fully discovered in terms of their valuations. It's very interesting. Most of the exits that we've made, we believe, are companies where the valuations reflected full discovery of the greatness of those companies. And hence, net, we've got a portfolio construct today with higher earnings growth and lower valuations, heading into a weak or an uncertain macro environment. And hence the hope that we'll be able to tide through this volatility and uncertainty in a reasonably prudent manner.